Oh, hello there. Bonjour and miigwech. Welcome to what I call Wading Through Economic Filth, or Wealth of Nation, where I seek to explain things going on in the Canadian and global economies. I'm Greg Quinn. I've spent the last 2 decades as a business reporter in Ottawa. I wrote a book, which you could see over my shoulder, about the work of Canada's central bank. Inflation and affordability have dominated politics and society in the last few years. The Bank of Canada is a big part of the picture when it comes to those topics. It's also not very well understood. So that's why I'm here. Today, I will discuss an emergency policy the bank deployed during the pandemic. It was the first time it had ever been used here. It's called Quantitative Easing, or QE. Soon I'll give a brief definition, and it will be more of an illustration rather than something too exact. Part of the reason for that is in my undergrad studies, there were only about 2 pages out of 600 devoted to extraordinary policy. So, a bit of a life lesson for me. Sometimes the most obscure lessons become the most important. In past videos, I referenced a low for long era where interest rates and inflation were low and very stable. That was great in many ways, but for central bankers, it creates a problem known as the zero lower bound problem. In normal times, if interest rates are high, you have a lot of room to cut them and provide relief to the economy when it stumbles. In the situation we were in before recent times, this low for long era, interest rates were quite low, and of course, the situation bankers were worried about emerged. The economy got very weak, and interest rates were cut to zero, and on the surface, there was nowhere else to go to provide stimulus. Some people argued that cutting interest rates was technically possible, but it was ruled out for some obvious reasons. Above all, I think it's hardly a confidence building exercise to have policymakers go and explain why interest rates are negative. So enter quantitative easing. Instead of policy being defined by the level of the central bank's interest rate, you can say it will now be measured by the quantity of liquidity being put into the financial system, or something that's like cash. I'll get more into the details of how this works later. Although some politicians found it a bit radical in Canada, it was not a radical policy in the central banking community. A lot of countries like the US and in Europe used QE after the failure of US banks and housing markets around 2008. Here, we decided not to use QE. A fresh young fellow named Mark Carney cut interest rates to something close to zero and gave what he called a conditional commitment to hold things there until the economy recovered. The economy did recover in many ways because Canadian banks were kept safe by sound regulation by OSFI, and also Finance Minister Jim Flaherty decided to run a record budget deficit. At the time, that was $50 billion, far short of what we've seen in recent years. Flaherty's name is now in the finance building, though you could tell he did not want to be known for big deficits. Anyways, Mark Carney's actions at the Bank of Canada cemented his reputation, and he was soon recruited to become the first foreigner to run the Bank of England. Sadly, lately he's taken a massive pay cut from his work in central banking in his earlier Goldman Sachs years to slum it in something called politics. But in 2020, however, the Bank of Canada, under a different governor, also cut interest rates to close to zero, and it became clear that the economy was staring into the abyss. Thanks to the pandemic, unemployment lurched above 10%. Many other employees were in limbo, trying to figure out if they were going to keep their jobs as people stayed home and companies shut their doors. The Bank of Canada, now under Stephen Poloz, had reached the zero lower bound problem. Luckily, the bank had prepared for years the idea of using QE, knowing that in the low for long era, it probably would have to be used at some point if we got into a major downturn. So the bank announced QE, which is essentially major purchases of bonds and investment markets, mainly Canadian government bonds. While the Bank of Canada's policy interest rate has a very strong influence of loans for a day or two, those are mostly done between major financial institutions. The bank's rate has much less influence on loans of, say, 5 to 30 years that are common for businesses and common for banks and common for consumers taking out mortgages. Not being able to cut interest rates further in a conventional way, buying a lot of federal bonds is a way to go into those investment markets for long-term loans and put pressure, downward pressure on interest rates. This is because most lending, again, as to firms and to consumers, are backed by bonds, which are sold in private investment markets, and they're really based on supply and demand. The problem in a downturn is that investors were likely to demand a lot of extra compensation for lending their money out. That pushes up the interest rates that borrowers have to pay to get a loan. That's a drag on the economy. The last thing you want in an economy that's already slowing. And historically, this is the Bank of Canada's job. It was founded in the Great Depression of the 1930s to make sure banks would return to lending after it had sort of frozen up in the early days of the Depression. So using QE would do a couple of things. By purchasing a lot of federal government bonds, you reduce the supply in investment markets and you make them more scarce. That tends to mean that investors wouldn't demand such high interest rates to make loans. And also, because most corporate bonds and consumer loans are sold at kind of a premium relative to government debt that's considered ultra safe, if you pull down the yields on government bonds, you open up that space for yields or interest rates to fall on loans made to companies and to households. Another way this works is that a lot of government bonds are held on the balance sheets of Canada's big banks. Again, they're very safe assets. So when the Bank of Canada buys up government bonds from the commercial banks, they in essence take them off the balance sheet of banks and kind of unlock something like cash. That in turn makes it more feasible for the commercial banks to keep making all kinds of loans. In a tangible sense, to be clear, the bank didn't load money onto Brinks trucks and ship them to bank vaults. This was all digital, and it wasn't quite cash as we know it. The bank, in essence, used its magical power to create new money or liquidity, and they used this to put a kind of interest-bearing credit on the balance sheets of commercial banks as they took their bonds away. The banks, again, could then have really low-risk assets, and then they could go out and make more loans. One point of historical clarification. Governor Poloz started the QE program, and Tiff Macklem took over in the middle of the crisis, and he kept it going. Macklem also wound it down much faster than other central banks. So there were political critiques at the time focused on firing Tiff Macklem. That left out the crucial fact that he didn't start QE. And in reality, trying to stop an emergency program before the economic recovery was clearly in hand could have been quite bad for confidence and for the economy. Another way of saying this is, after the 2008 global downturn, many economists felt a big reason the global economy remained so sluggish for so long was that fiscal authorities who took the lead turned off the taps too soon, and that undercut the quality of the recovery. While economists generally agree QE was necessary in an emergency, there are some vexing questions left over. What did we really learn about an exit strategy? How do you know when it is safe to turn off the taps? And how do you know when the taps need to be turned off? After all, economists worry about something they call moral hazard in offering central bank relief. That's a world where if there's a crisis that's kind of triggered by bad behavior in financial markets as opposed to a pandemic, some investors may deliberately cheat, safe in the knowledge that the government is going to bail them out in some form. So you do have to be a little bit careful about how much government relief is on offer and for how long it lasts. And did we really figure out the right balance between fiscal stimulus or deficit spending that was backed by Parliament and is within the democratic system, and monetary stimulus done at an independent central bank that still carries major consequences but is much harder for the public to understand? You know, the Bank of Canada's balance sheet grew from something like $125 billion before the pandemic to something like $500 billion at the peak. That's something on par with the amount of fiscal deficits that were run during the pandemic. But the Bank of Canada's operations have received far less spending. There is no election, after all, on the Bank of Canada put to the public. Again, that was a lot of money to put out there, or at least a lot of public resources. Did we get what the Auditor General would call value for money if she was examining the Bank of Canada's books the way the PBO or the Auditor General scrutinized government spending programs? You can also ask a very basic question. Given the grim prospects facing Canadians when the economy was shut down to save lives during COVID, did the Bank of Canada really have any choice but to deploy all of its toolkits, even untested and more exotic ones? There was also political criticism that the bank was financing Justin Trudeau's reckless deficits. It didn't really work quite that way. The purchases of government bonds made by the Bank of Canada were done in what are called secondary markets. These were bonds that had been sold in the past and were, again, largely sitting on the balance sheets of Canadian banks and other investors. While interest rates for government bonds may have declined because of the program, in no way was the Bank of Canada buying bonds that were being sold by the government of the day and knocking those yields down to make it easier to sell bonds. So it was perhaps too far a case to say that the central bank was directly financing the operations of the government. Another outstanding issue is that it's still perhaps a bit of a question how much borrowing costs actually declined and how much punch we got for quantitative easing. Some early research by the bank estimated that it might have been on par with one or two normal interest rate cuts in terms of lowering borrowing yields for businesses and consumers. Later they upgraded that, but it certainly wasn't on par with how much conventional interest rates had been cut in past economic downturns to boost the economy. So in other words, we did deploy a lot of public resources. The Bank of Canada did take some kind of risk, and the benefits were not massive. I am not aware of any economist that said QE was the decisive factor, bringing the economy back to life. And the other question we now have is that interest rates were taken up quite high to about 5% as inflation increased after the shutdowns ended. But they've settled back down. They're now 2.25%. We may be back in the same situation again in the future. We don't have an incredible amount of room to cut interest rates if there's another economic calamity. So a question is, what will we do next time? What will be the cost and scope of QE in a future downturn? Or will we be more confident and willing to deploy more QE than we did in the past? Will we leave it in place for longer? Will it be smaller, more circumspect? It's hard to know these things because we don't know exactly what the next crisis will be. It's also not clear that the public understands or accepts these kinds of trade-offs. So on the surface, again, to go back to the costs, because the Bank of Canada has the power to create money or liquidity, there may not be a lot of direct costs to running a QE program. The Bank of Canada did take some losses on its QE program, but this was a very small percentage of the amount of liquidity that was pushed into the economy. And as officials have argued, the exact way that the deposits are put on the balance sheets of commercial banks, they're almost designed to be some losses attributed to the Bank of Canada as the economy picks up. That's sort of part of the cost of doing business. This is a technical explanation. I don't really want to get in here. So I think what we could say at this point is the Bank of Canada was well prepared. They'd done a lot of research before they deployed QE. They have done a review and they say they have learned a lot from its use. But have lawmakers learned those lessons? Are they asking those questions? And the public really has not. So these are things, again, in a spirit of civic ownership of public institutions, things worth thinking about in the future. Before I close, rather than to tell you to read my book, I want to recommend a book I have found useful This is called In Your Best Interest: The Ultimate Guide to the Canadian Bond Market. It's by a bond manager I spoke to over the years called Hank Cunningham. I don't think it touches on quantitative easing very much, but in terms of the other things I spoke about how bond markets work and how they transmit borrowing costs and mitigate them between investors and businesses and the public, it's a very good, readable explanation, and there are a lot of also good, I think, personal finance tips in there for people. So that's that. A complicated subject. Hope you enjoyed it. See you again next time.